I'm Michael Cogdill, and you're watching Retire Ready Today with TRUNorth Advisors. And today we're talking about 3 retirement tax traps that could wipe out your hard-earned savings. Joining us is Matt Dixon. He is the founder of TRUNorth Advisors. Matt's a fiduciary retirement advisor, a registered financial consultant, and a member of the Forbes Finance Council. Matt, welcome. Thank you again for being here today.
Thank you, Michael.
Tell us about that 3rd retirement tax trap.
And Michael, the 3rd tax trap, what that is not protecting yourself now against higher taxes in the future. Because if you're in or nearing retirement, it's not a matter of if taxes will go up, it's only really a matter of when. And this could be a devastating blow for your IRA, 401k, and other retirement savings. Most people believe they'll be paying fewer taxes in retirement. And I get that because you're no longer earning a paycheck. But unfortunately, that won't be the case for many hardworking Americans. By the time you add up the taxes on your IRAs, 401k withdrawals, taxes on your Social Security benefits, and taxes like other investment income that could be dividends or even real estate, you could find yourself in a higher tax bracket after you retire than when you were working. But it actually could get worse. For the last few years, the government has gone on an unprecedented spending spree between economic stimulus, new infrastructure, and social policy bills. Our national debt has reached a record high, and they're still spending trillions of dollars every year. But it's important to understand the government doesn't have money of its own. So the only way to repay this money is by raising taxes.
And Matt, it's a daunting question. How high could those tax rates climb?
Michael, it could be an extreme. If it was possible, it may go there, because the highest federal income tax rate right now is only 37%. But do you know what it was back in the 1980s? The highest federal income tax rate was 70%. Now, I'm not saying that taxes will go back to 70, but I am saying there's a lot of room between 37% and 70% for the government to be able to raise our taxes. It really comes down to simple math. We have the highest national debt in our country's history, and we have the lowest federal income tax rates in over 40 years. So what do you think is going to happen? The answer is obvious. Taxes must go up.
Quite the inevitability, Matt. So how could this affect retirees?
Well, Michael, it could be huge, right? If you've recently retired or you're even nearing retirement, it's not good at all. Each time you have to take a withdrawal from your IRA or 401k, a larger chunk of your savings would go to Uncle Sam. And you'll ultimately be left with a lot less money to spend in retirement. The same will be true with income from your Social Security benefits and any other investment income from dividends, real estate, and more.
Matt, is there anything else retirees need to be wary of here?
Absolutely, and I'm really glad that you asked that, because there's one more thing I do want to mention here that nobody's talking about, and right now it's important to understand. It's something called legislative risk. Legislative risk is basically admitting that the government can change the rules of the game whenever they want, and as individuals, we're largely powerless to stop them. The government can raise your taxes. They can change rules on your IRA or 401k accounts like they've done here in recent years. They can cut your Social Security benefits as they've already told us that they're going to do by 2034. They can do whatever they want, whenever they want, and they don't have to ask for your permission. And that's why more and more people are taking proactive steps right now to Washington-proof their retirement savings. And when the government does change the rules, you're protected.
So this begs the big question. How can our viewers out there Washington-proof their retirement savings?
It's a very, very good question, because Washington-proofing their retirement savings, this is a big one, especially if you're concerned about the very real risk of higher taxes here in the near future. Your traditional IRAs and 401ks are what's called a pre-taxed account. You haven't paid taxes on that money. Not when you put it in, and not while your investments have grown. But when you take this money out, the tax man will want his cut. And with the required minimum distribution, RMDs, you can't leave the money in there. You have to take the money out. With a Roth, though, you do have to pay taxes up front, even if you're converting from an IRA or 401k. But once the money is inside the Roth, every dollar of your growth is tax-free. Any dollar that you take out is tax-free. Once the money's in there, you pay zero taxes, no matter how much the money grows. And there are no required minimum distributions either, which is a huge benefit because you're in a total amount of control of when you get to take the money out now. The more money you have in the traditional IRA and 401ks, the bigger the tax bills you can have to expect to end up paying in retirement. You haven't paid a dime in taxes yet, and Uncle Sam can't wait to take his share of those types of accounts. But if you can convert to a Roth today at today's historically low tax rates, all future withdrawals would be completely tax-free. No more taxes on that money for the rest of your life. If you haven't considered converting your traditional IRA or 401k into a Roth, now might be the perfect time to be able to do that.
I'm sure a lot of our viewers out there could benefit right now from a Roth conversion. How can they find out more, Matt?
So it's a really simple process, but a Roth conversion could be very important. And at this point, you might be asking yourself some important questions like, how much could you save in taxes by converting even from an IRA or a 401k into a Roth? If it makes sense, should you convert all of your pre-tax accounts this year into a Roth account? Or should you do it over a few years? This can be a powerful tax-saving strategy if you do it right. And we can help you do that with a free customized Roth conversion analysis.
Matt, sounds great. How's it work?
Really simple. And in fact, we make it about as simple as you can get because we get some basic information from you first about your accounts, and we do all the math for you to show you the difference between sticking with your traditional IRA or 401k versus if you did this conversion to a Roth. And then you get all of the facts and the numbers you need to help you make the right decision. Many advisors only do this for their existing clients, or they charge thousands of dollars for this type of customized analysis. But we offer this at zero cost, even if you're not a client yet. We're here to help. For many people, today's historically low tax rates mark your best opportunity ever to convert to a Roth. So let's find out how much you could save with a Roth conversion.
Matt, this is so helpful, so informational, so generous of you. It's easy to schedule a Roth conversion analysis with TRUNorth Advisors with those locations right here in the Carolinas. Again, if you have saved at least $200,000 for retirement, schedule your free analysis right now by calling 864-528-3110. This offer, though, is available only if you call today. So call right now, 864-528-3110. That's all the time we have for today. We thank you for watching Retire Ready Today with Matt Dixon of TRUNorth Advisors. We look forward to seeing you next time. And remember, it's not what you make, it's what you keep.